Imagine making financial moves with the shrewdness and strategic advantage you see in the world's wealthiest individuals. Forget fleeting trends or supposed secret knowledge. This is about understanding the fundamental ways our human minds work, the predictable errors we often make with money, and how those at the highest financial levels seem to navigate these psychological currents. Welcome to your personalized deep dive. You've brought some truly fascinating material to the table, and today we're going to dissect how applying the core principles of behavioral economics can help you cultivate what we're calling a billionaire mindset.
Yeah, and what's immediately interesting is that this isn't just about having more zeros in your bank account, right? It's about a fundamentally different way of thinking about wealth, risk, and opportunity, often rooted in an intuitive grasp of human behavior.
Exactly. Our goal today is to really understand how the ultra-wealthy appear to approach their financial lives. We'll be exploring those key mindset shifts they often employ, sometimes without even consciously realizing it, that give them a distinct strategic edge.
Hmm.
And most importantly for you, we're going to extract actionable, real-world hacks, practical strategies that ambitious professionals, entrepreneurs, investors, well, people like you can start implementing right now. We have a fantastic collection of insights here, ranging from rigorous academic studies on investor behavior to hands-on guides on wealth accumulation, and even some surprising perspectives from business psychology. So let's dive right in.
Let's do it.
One of the foundational ideas in behavioral economics is that we don't always act as rationally as traditional finance models assume.
That's right. The bedrock of classical economics often rests on the concept of the perfectly rational actor.
Mm.
Homo economicus, right?
Right.
But as the research in economics and business management clearly illustrates, real human beings, we're influenced by a whole host of psychological factors when making financial decisions. Our emotions are ingrained biases. These are powerful drivers that often lead us away from purely rational choices.
And it's not just everyday folks who are susceptible. Even seasoned professional traders, people whose livelihoods depend on making sound financial decisions, are not immune to these biases, as one of our sources points out.
Yeah, it's surprising but true.
When you look at the data on how average investors perform, it paints a pretty clear picture. Studies like the Barber-Odin research, for instance, consistently show that individual investors tend to underperform the broad market indexes.
Oh, definitely. We see this repeated in various studies. The 2020 Delbar analysis, for example, found that equity investors earned over 5% less than the S&P 500 in 2019. That's significant.
Wow, 5%?
Yeah. And fixed income investors also fell short of their benchmarks. This isn't just random variation,
Yeah.
It strongly suggests that there are systematic, predictable factors at play, and behavioral economics provides a powerful lens for understanding these psychological influences.
Okay, so if we accept that these biases exist and that they demonstrably impact investment outcomes, the crucial question becomes, what are these key biases? And how might someone with a billionaire mindset consciously or unconsciously navigate or even leverage them? Let's start with a bias that I think many of us can relate to, loss aversion.
Loss aversion is a really fundamental aspect of human psychology. As our source, How to Combat Behavioral Biases in Your Personal Finance explains it. The emotional pain we experience from a loss is significantly greater than the pleasure we feel from an equivalent gain.
Right. It stings more.
Exactly. For the average investor, this can lead to being overly cautious, maybe avoiding potentially rewarding risks, and as you mentioned earlier, holding on to losing assets for too long, just to avoid acknowledging a mistake.
Right. It's almost like our brain is wired to be more sensitive to potential downsides than to potential upsides of the same magnitude. So how might someone operating with a billionaire mindset approach loss aversion differently? It strikes me that they likely maintain a much longer-term perspective, so short-term fluctuations, maybe even losses, might not trigger the same emotional response.
Exactly. Their focus is often on building and preserving wealth over decades, across market cycles. Therefore, short-term volatility is less likely to evoke that powerful emotional aversion to loss. They probably view temporary dips as simply part of the broader investment landscape, maybe even opportunities, rather than personal financial catastrophes.
That longer-term orientation seems absolutely key. So what's a practical hack that you, our listener, can use to counteract loss aversion in your own financial life?
Well, drawing from How to Combat Behavioral Biases and the insights of people like Morgan Housel, a critical strategy is to develop a robust, well-thought-out long-term investment plan, and then, crucially, stick to it. Educate yourself to understand that market fluctuations are normal, that temporary downturns are just an inherent part of the journey. Avoid making impulsive decisions based on, short-term emotional reactions to market news or perceived losses.
Solid advice. Okay, let's tackle another common psychological hurdle, the fear of regret.
Yes, the fear of regret. It ties in closely with loss aversion, actually. Our Understanding Investor Behavior source defines it as the distress we feel when we realize we've made a suboptimal decision. In the context of investing, this often manifests as clinging to underperforming investments. The logic, although it's flawed, is that as long as you don't sell, you haven't officially locked in the loss, and therefore you can avoid the regret of having made a poor investment in the first place.
It's like avoiding looking at your bank balance after an impulse purchase. But when it comes to investments, this reluctance to face reality can be really damaging. So how might a billionaire approach the feeling of regret in their financial dealings?
It's plausible they cultivate a different relationship with mistakes. Perhaps they view them less as personal failings and more as valuable learning experiences, necessary data points that inform future decisions. The Trump University wealth building material, with its emphasis on action and forward momentum, seems to suggest a mindset that doesn't dwell excessively on past errors. It's more about what's next.
Okay, so less dwelling, more learning. What's a tangible hack to help our listener manage the fear of regret?
This is where the power of pre-commitment comes in. As suggested by Valley Star Credit Union and the Behavioral Economics Toolkit, establish an advanced, specific, objective criteria for reviewing and potentially selling your investments. Set these rules when you're thinking rationally, calmly, not in the heat of an emotional moment.
Makes sense.
Then at predetermined intervals, say quarterly or annually, evaluate your portfolio based on these preset criteria, regardless of your current emotional attachment to any particular holding.
That's a really proactive way to take emotions out of the equation, or at least minimize their influence. Now let's talk about overconfidence and optimism bias. I suspect many ambitious individuals, particularly entrepreneurs, might see good of themselves in this.
Oh, absolutely. Overconfidence is our tendency to overestimate our own abilities and knowledge, while optimism bias leads us to believe that positive outcomes are more likely for us than negative ones. The research from CELO Brazil highlights how these biases can lead both investors and entrepreneurs to underestimate risks and base their plans on overly optimistic assumptions. Barbara Odine's work also touches on the prevalence of overconfidence in trading environments.
It's that feeling of, I've got this, even when the objective data might suggest otherwise. And while a degree of confidence is often necessary to take initiative, right? Unchecked overconfidence can be a recipe for trouble. How might a billionaire maintain confidence while mitigating these biases? I imagine their confidence is grounded in something more substantial than just positive thinking.
You're likely right. While they might project a strong sense of conviction, it's probably balanced by rigorous due diligence and a genuine openness to diverse, even dissenting opinions. The Trump University wealth building materials, while advocating for a strong belief in one's ability to succeed, also emphasize the importance of thorough preparation and really understanding the landscape. It's confidence backed by work.
Okay, confidence plus preparation. So what practical step can you take to avoid the pitfalls of overconfidence and optimism bias?
The Behavioral Economics Toolkit recommends a powerful technique called a pre-mortem. Before you commit to a significant financial decision, buying a property, launching a business, making a large investment, take some time to imagine that the decision has failed spectacularly.
Ooh, grim, but potentially useful.
Exactly. Then brainstorm all the possible reasons why it might have failed. This exercise forces you to proactively identify potential risks and blind spots that your natural optimism or overconfidence might have caused you to overlook. Furthermore, actively seek out the perspectives of those who hold contrary views, as Kevin Foe, MD, advises. Don't just surround yourself with people who agree with you. Get challenged.
That pre-mortem idea is like conducting a reverse stress test on your plans. I like that. Okay, let's move on to how the actions of others can influence our financial decisions. Herd behavior.
Herd behavior is simply the tendency to follow the actions of a large group, often based on the assumption that if so many people are doing something, it must be the correct course of action. Kevin Foe, MD, provides examples of this even within professional circles, like medicine. For the average investor, this can lead to chasing hot trends or popular investments, even if those choices don't align with their individual financial goals or risk tolerance. FOMO, fear of missing out, is a big driver here.
We've all felt that pull, haven't we? Seeing a particular stock or crypto surge and feeling like we need to jump in to avoid missing out. But how do you think someone with a billionaire mindset approaches these situations? Do they just ignore the crowd?
They likely prioritize independent thinking. They're more inclined to base their decisions on their own in-depth analysis, their long-term strategic vision, and their understanding of fundamental value, rather than being swayed by fleeting popular sentiment or that fear of missing out.
Yeah.
Insights from Morgan Housel and the Trump University wealth building approach both suggest the importance of defining your own investment philosophy and sticking to it, regardless of what the crowd is doing.
Define your own game plan. So the practical hack here for our listener.
Before making any significant financial move, take a moment to critically examine your motivations. Ask yourself why you're considering this particular action. Is it based on your own thorough research, your clearly defined goals, and your comfortable level of risk? Or are you primarily reacting to what everyone else seems to be doing? As Morgan Housel advises, understand the game you're playing, and don't take your cues from those playing a different one.
That's a really crucial point about aligning your actions with your own specific goals, not someone else's. Now, let's discuss a bias that can really impact our long-term planning, present bias.
Present bias. Our innate tendency to place a significantly higher value on immediate rewards and gratification compared to future benefits. The Behavioral Economics Toolkit explains how this bias can lead to procrastination on crucial financial activities like saving and investing, because we prioritize immediate consumption, that new gadget, that vacation, over long-term security.
It's that constant tug of war between what feels good now and what's good for our future selves. It's so easy to see how this can derail even the best-intentioned financial plans. How might a billionaire approach this inherent bias towards the present? They must have cracked this code somehow.
Well, they likely cultivate a very strong future orientation and a greater capacity for delayed gratification, at least when it comes to building wealth. Both Morgan Housel and the Trump University wealth building materials underscore the necessity of a long-term perspective and the willingness to forego immediate pleasures for substantial future gains. It's about prioritizing the long game.
The long game. So what's the practical way for you, the listener, to combat present bias and prioritize your financial future? How do we strengthen that future self muscle?
Automation is absolutely key here. As recommended by Valley Star Credit Union and Trump University, automate your savings and investment contributions. Set up regular automatic transfers from your checking account to your investment accounts, essentially paying your future self first before you even have a chance to spend it.
Make it automatic, make it invisible.
Exactly. Additionally, establish clear, meaningful, and SMART, specific, measurable, achievable, relevant, time-bound financial goals. This helps you visualize and connect emotionally with those future benefits, making them feel more tangible and less abstract. Trump University specifically advocates for implementing an automatic investment program, AIP, where a predetermined percentage of your income is automatically allocated to investments. Take the decision out of your hands each month.
Automating definitely removes that immediate temptation to spend. Okay, finally, let's touch on the concept of mental accounting. This one's a bit more subtle.
Yeah, mental accounting is our tendency to mentally categorize and treat different pools of money differently, often based on arbitrary factors like where the money came from or what we intend to use it for. The work of Barbara Dean and Nobel laureate Richard Thaler has extensively explored this.
Can you give an example?
Sure. For the average person, this might mean being more willing to splurge with a tax refund or a small inheritance than they would be with money from their regular salary, even though rationally a dollar is a dollar, right? Or maybe earmarking certain savings for a vacation fund while carrying high-interest credit card debt.
Right, it's like having invisible labels on our fund money, serious savings, windfall cash, influencing how we're willing to use it, even if those labels don't make rational financial sense. How would someone with a billionaire mindset likely view their overall capital? Do they have these mental boxes?
It's highly probable they adopt a much more integrated and holistic view of their financial resources. All their capital, whether it's from business profits, investments, salary, whatever, is likely seen as interchangeable and as tools to achieve their overarching financial objectives, less constrained by those artificial mental categories.
A unified pool of capital. So what's the practical hack to help us overcome the limitations of mental accounting?
The key is to consolidate your financial accounts where possible and consciously strive to view your entire financial picture as a unified whole. Look at your net worth, your total assets, your total liabilities. This will enable you to make more rational and strategic allocation decisions based on your overall financial goals, like paying down high-interest debt first, regardless of where the money technically came from, rather than being influenced by the arbitrary mental boxes you might have created.
These are all incredibly powerful insights into how our own psychology can sometimes work against our financial best interests. Now, our Trump University Wealth Building 101 source offers some specific billionaire mindset shifts that build on these ideas, moving beyond just avoiding biases.
Indeed. One significant shift they highlight is the focus on actively generating income, not just on saving. While they use a rather extreme analogy, the core principle of actively seeking to increase your income streams through business, side hustles, upskilling is presented as a key differentiator from just focusing on cutting expenses.
Right. It's about expanding your financial horizons rather than just trying to shrink your expenses. Playing offense, not just defense. Another mindset shift they emphasize is the power of visioning.
Yes, this involves the consistent practice of vividly imagining and visualizing your financial goals to create a powerful internal drive and motivation. They actually suggest creating a formal financial vision statement and reviewing it regularly, perhaps even using visual aids like pictures of that dream house or debt-free statement, making it feel real.
It's about making those goals feel real and tangible, keeping them at the forefront of your mind. They also stress the importance of being highly action-oriented.
Yes, cultivating a bias towards taking prompt action,
Yeah.
like immediately setting up that automatic investment program we discussed. There's an understanding that inaction carries its own costs, missed opportunities, the corrosive effect of inflation, delayed progress towards your goals. Don't just plan, do.
Get started today. Another interesting perspective from this source is their approach to embracing entrepreneurship, but with careful consideration.
Right. They view business ownership as a significant pathway to substantial wealth creation. But, and this is important, they also emphasize the need to rigorously assess and mitigate risks through thorough due diligence and strategic outsourcing. It's not about reckless gambling, it's calculated risk-taking. Their belief, as presented, is that with a step-by-step approach, the chances of entrepreneurial success are actually quite good.
Calculated steps, not giant leaps in the dark, which directly relates to their concept of strategic debt management.
This involved developing a clear and proactive plan to become debt-free. Not just wishing it away, but having a system, maybe like the debt snowball or avalanche method, focusing on building momentum through consistent action and celebrating the achievement of milestones along the way, making progress visible.
Okay, and a slightly contrarian idea presented in the material, the anti-budget approach.
Yeah, this was interesting. Rather than solely focusing on restricting expenditures, tracking every penny, their automatic money system prioritizes strategies for increasing income, maximizing savings through automation, and consistent investing. The idea is if you get the big things right, earning more, saving automatically, the minor expense tracking becomes less critical.
Focus on the big levers. Finally, they highlight the importance of leveraging assets strategically.
This involves understanding the potential of income-generating assets, particularly real estate is mentioned frequently, and considering the total expected returns, not just cash flow, but also potential appreciation, the benefits of using leverage, borrowed money, and potential tax advantages, rather than perhaps solely focusing on traditional stock market dividends. A broader view of asset returns.
So that's a lot to digest. To quickly recap some of the practical hacks we've explored today to help our listener cultivate this billionaire mindset.
Okay, quick run through. Develop and stick to a long-term investment strategy. Pre-commit to objective investment reviews and selling criteria. Use the pre-mortem exercise for major financial decisions. Actively seek out diverse and even contrary opinions. Automate your savings and investments, super important. Set and regularly visualize SMART financial goals. Consider implementing an automatic investment program, or AIP. Develop a clear, actionable debt elimination plan. Actively focus on increasing your income streams. Regularly practice financial visioning. Adopt an entrepreneurial mindset. Identify opportunities, manage risks, and strive to view your finances holistically, breaking down those mental accounting barriers.
That's a really comprehensive set of actionable strategies, and the overarching takeaway from our deep dive today seems to be that building significant wealth isn't solely about the numbers themselves. It's deeply intertwined with understanding your own psychology and proactively working to counteract the inherent biases that can often hold us back. By consciously adopting some of these billionaire mindset shifts and consistently implementing these practical hacks, you can begin to make more strategic and hopefully more effective financial decisions starting today.
This brings up a crucial point for you, our listener, to think about. Reflecting on the behavioral economics principles we've discussed, loss aversion, overconfidence, herd behavior, present bias, all of them, which of these biases do you recognize as potentially having the most significant influence on your own current financial decision-making? Be honest with yourself.
Hmm.
And maybe more importantly, what is one specific small but concrete action you could take this week, not someday, but this week, to begin thinking and acting more strategically with your money, inspired by what we talked about?
Those are powerful questions to consider. Really personalize it. As a next step, we highly encourage you to revisit the materials you shared with us, maybe paying particular attention to the sections on goal setting and the development of a clear financial vision. Start to formulate your own personalized billionaire mindset action plan based on these insights.
Thank you for joining us on this deep dive. We trust that this personalized exploration has provided you with valuable insights and, more importantly, some practical steps to propel you forward on your financial journey. We look forward to our next exploration together.